Greetings. My name is Adeshola, and I'm one of the co-managers in Gkad Enterprise. My other co-managers are Christian and David. We're going to go over the business strategy in Industry One. And I'll start with the agenda. I will be covering the strategic vision, the initial and final strategic group map, and David will go over the results, and we'll have Christian go over the computer's analysis strategy, and we'll end with the lesson learned. Okay, at Gkad Enterprise, we believe that being a broad differentiators allows us to serve our customer better. And really providing high quality athletic food and help maximize profits. Just as a statement, our vision is to become the leading provider of athletic footwear brands globally, with a strong emphasis on delivering high quality product to maximize value for our stakeholders. As far as the initial mapping goes, we initially certainly were very decisive in terms of being a broad differentiator. We took that approach, and there are a lot of things that we learned along the way just with that approach. One of the things that we did as a team was we certainly decided to go over a much brand, but we were not too decisive if we wanted to go to the extreme of that 500 models. But we decided to stay around the 300 to 350 model. Certainly, one of our strategic vision is to produce high quality, but we started with an SQ rating of about that 6 to 6.6 range. And while we're doing this, certainly we didn't have much data about our competitors and what they're aiming for. So I think one of the things that we did was just maybe we faced challenge in quantifying our objective and being very decisive at the early stage. As you can see in North America in the chat, we're certainly trending on that being a broad differentiator. And based on that, during the very year 11, we were the front runner. So we made a good decision at the early stage. But I think where we shot for was just not being too decisive. All right. On the final stage, really beginning from year 12 to year 17, we adjusted our strategy several times. We actually had models of about 500 different models. We increased our sales volume. And that actually helped us. We became a little bit more intentional of our SQ standard. Our image rating was high, and based on that we began to see good margin from the stock price and earnings per share in general. So we certainly were consistent in being a broad differentiator, but we certainly improved and actually increased the brand and increased that volume in general, and that helped us throughout the project. So I'll pass this on to David to go over the result.
Okay, my name is David McClung, one of the co-managers for Gkad Enterprises. For our net revenue, we experienced a steady increase in sales volume for year 11 through year 14, resulting in a significant rise in our net revenue. We maintained a broad differentiation strategy through the 7-year period, making quality and pricing adjustments with the strategy in mind that we would continue to nudge ourselves into a relatively empty space on the strategic map and maintain a competitive portion of overall market share. This was relatively successful up until year 15. In year 14, we had recaptured a portion of the lost market share, and we were tightly competing with our strongest rival, Team H. We slightly mistimed our scale down in North America and left ourselves in a position which we were not able to capture private label revenue and still meet market demand in year 15. In year 15, Team H made a radical shift towards a lower cost strategy and captured a significant portion of the market. And while we held our ground in North America and Europe, we lost market share in Asia Pacific and Latin America. In years 14 and 15, we were able to improve revenue in the internet segment through increased marketing efforts, which did help offset reductions in revenue in the wholesale segment. We determined that if we were not positioned well to follow Team H and compete in an all-out price war, we should continue with the path we put ourselves on. We chose to engage in only slight reductions in quality and price and try to continue to occupy what we considered to be a fairly open but still profitable section of the strategic map. This trend continued through years 16 and 17. In years 16 and 17, we had also reduced our quality somewhat once again to maintain profits. And while net profit margin increased steadily through years 15 through 17, overall revenues remained effectively flat. We also had lost a bid on a major celebrity endorsement, which may have damaged the attractiveness of the brand in year 17. Net revenues may have been better in later years if we'd invested in expansion earlier and maintained our overall quality in the last 3 years of the 7-year period. Next slide, please. For earnings per share, our growth remained steady year over year as we maintained our focus on a strategy of maximizing profits and making sure we reduce cost. We experienced a slight flattening in our year 14 earnings per share, and this is predominantly due to a stock issuance in year 13 and increased expenditures in year 14. We did not initially anticipate that Team H would move so aggressively in our direction on the strategic map. Our plan had been to incrementally pursue our broad differentiation strategy and move up and to the right on the strategic map gradually as the game progressed. We were forced to revisit this strategy and plan more aggressively starting in year 13. In year 14, faced with some erosion in our position as Team H became consistently more competitive, we began aggressively competing by increasing our SQ rating to 7.7 and increasing our product line up to 500 models. This was an expensive move, but we felt it was necessary to make investment and maintain our market share. We also chose to purchase equipment in year 14 to increase SQ ratings more cheaply in coming years and added additional production capacity in our Asia Pacific plant with a long-term plan of relocating production from North America. In addition, we increased both internet and wholesale marketing budgets in year 14 to recapture a portion of the lost market share. Overall, this was a fairly expensive year, and this is reflected in the EPS trend as the difference in EPS from year 13 to 14 is effectively flat. Beginning in year 14, we began a practice of proactively and progressively repurchasing stock. Along with increased net profit margin and cost reductions, this helped to drive earnings per share continually higher in years 15 through 17. Next slide, please. Despite flat revenue from year 14 through 17, we continued to observe an increase in our stock price. In the early years of the 7-year period, consistent stock price growth was attributable to strong revenue growth, maintenance of a good credit rating, some small dividend payments, and consistently exceeding stockholder expectations. A slight dip in stock prices in the year following year 13 is attributable to some degree to stock issuances in years 12 and 13 that were executed to fund expansion without incurring an overburden of debt. Earnings per share increased steadily over the 7-year period, with the exception of a fairly flat year 14. As with other metrics, the changes noted around year 14 are a result of increased competition and the necessity to fund improvements in quality and capability in order to react to some loss of market share. While year 15 was extremely challenging and represents the first year we lost our lead in the industry, stock price began to improve once again as we cut costs and improved profits. Year 15 was also the first year that we left North American production behind completely. This improvement in profitability, reductions in costs, and our strategy of aggressively repurchasing stock helped to drive stock prices in the last 3 years. This also helped drive positive EPS changes, and we once again began to experience increases in return on investment. Let me turn you over to Kirsten.
Hi, my name is Kirsten Tillinghast. I'm the final co-manager of Gkad Enterprises. I'm just going to be talking about the competitor analysis. Obviously, as we've stated multiple times, Helix Footwear Company H was our biggest competitor. In year 11, it seemed that everyone was kind of going for the broad differentiation strategy, but by year 12, they definitely made their move towards being the broadest differentiator, not only in just the amount of shoes, but with their quality of shoes, and that afforded them the majority market share, which they maintained pretty much for the rest of the game. Most of their efforts seemed to be put towards advertising and celebrity endorsements, which really gave them a lead in their image rating, which could definitely have led to bigger sales volume. After they gained the market share, they stayed on top, eventually becoming a low-cost differentiator with more models, a higher quality shoe at a much lower price. The gain in their sales volume also drove their EPS and stock prices up, which increased their shareholder value, which gave them a more attractive standing as a company. Their debt hurt their attractiveness marginally, which we kind of assumed might hurt them in the long run, but it seemed to have paid off, and they bounced back truly effectively, which led them to stay on top as far as market share and be an effective competitor. Next slide, please. I think if we were to continue going on with the game, there were a few things that we would probably do differently. We would stay a broad differentiator. We would do that by trying to increase retailer support, create a higher quality shoe at a lower cost. Doing so, in order to do that, we would move the majority of our remaining production to Asia Pacific, just because the costs to produce there are much lower, which would give us that flexibility. And we would try to increase the sales volume by at least 50% to increase directly with Helix. They were producing about twice as many shoes as we were. So in order to compete with them in the market share, that's something we would definitely want to increase on our end. Another major thing we would try to increase is the advertising efforts, as well as the celebrity endorsements. That was something we noticed they spent a very good chunk of money on at the beginning, and definitely led their way to a good image and appeal for a consumer base, as well as the high quality shoes, which we would continue to have a goal of satisfying an SQ rating of 8 or higher. Next slide, please. So some general lessons I feel like we've learned as a team is that we need to have a clear strategy before entering the market and being committed. This was definitely a first time game experience for all three of us, and we've learned a lot in that aspect. It's important that we have a differentiation strategy that sustains the competitive advantage. We stayed in the lead for quite some time as far as a top competing company. But where I think we started to lack was, again, the amount of shoes, the quality of the shoes, and also being able to look forward at our competitor moves and use that information to make better adjustments in the market. And then a final thing we would definitely want to pay attention to in the future is exchange rates and how that's going to impact all of our financial bottom lines, especially with trying to produce in less appealing markets or countries. So that was our presentation.
Thank you very much.